Hi, everybody. Welcome to TradeStation for our afternoon webinar. It is afternoon here in the Midwest, and so I'm going to use it as a time reference. I know many of you are in different time zones. We want to welcome you today to this very exciting presentation from a very high-level speaker, and that's Mr. Phil Town. Phil has been a guest on multiple occasions on CNBC. He's been featured on the Millionaire Inside series, and he appears in the first and second episodes of Your Guide to Wealth and Your Guide to Retiring Rich, along with David Bach and Barbara Corcoran. He's been a regular contributor to MSNBC's show Your Business, and he has appeared with Maria Bartiromo on her show, The Closing Bell. We're very lucky to have Phil Town with us today of Rule 1 Investments, as he helps us with the understanding the most practical strategies for 2018. TradeStation's philosophy is to offer you the best, most objective, most actionable information in a very timely manner to help you increase your odds of making a successful trading decision. So today, Phil Town is going to be able to help us meet all of those goals. Now remember that our presentation is for educational purposes only, and all the symbols and all the trading ideas that we discuss here are for demonstration purposes only. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading may not be suitable for you because it's not suitable for everyone. And options trading itself does carry a high degree of risk and may not be suitable for all traders. In other words, you need to know what your suitability is and what your risk parameters should be. So take a look at the disclosure information in those PDF handouts I've made available in the chat panel, and also these documents are available to you on the TradeStation website for your viewing at a later time. I'm going to turn things over to Phil Town right now, and I want to welcome him. This is his first webinar with us here at TradeStation, and we're very excited. Thanks for coming, Phil.
Don, it's a pleasure to be here. Thanks for having me.
Mine.
We're going to dive deep into what we call rule number 1 strategy. And I would be happy to try to field questions when we're done if there's some way to feed those through. Don, do you guys have a mechanism for that? And you guys could check as we go. So let me just start with this. I'm not a Wall Street trained guy. I didn't go to a business school. I basically was a river guide in the Grand Canyon when I started investing, and I started learning how to do this kind of trading. And I basically almost drowned a guy who ultimately turned out to be a pretty amazing mentor who was willing to teach me how to invest and how to do it in such a way that my risk was very low. And I started off in about 1980 with about $1,000 after apprenticing to this guy for a year, and kind of learning these strategies. And I built it up to $1.5 million back then in 5 years. So by 1985, I was I had $1.5 million liquid, which is, it's not huge, but in today's dollars, it's about $3 million starting with 2,000. So that's decent. And then I continued from there, and I'm going to show you guys some of the things that are basic to that kind of level of success, particularly when you're starting off with very little capital. The fundamentals of investing become, in my view, very, very important. And I'm going to show you a couple of slides here that come to me from just digging around on the internet about modern portfolio theory, which is essentially how most people trade options, and some entire options trading platforms are built entirely around modern portfolio theory, with the idea that investors are rational, that the price of a company, the price of a stock, is always equal to its value, or most always equal to the value, and that effectively no one can beat the market, that you have to take a lot of risk to beat the market. This particular brand of thinking was honored with 2 Nobel Prizes, one with Eugene Fama, who developed this idea at University of Chicago back in the late 1960s. And he said basically at his Nobel Prize hearing, or speech, that I'd compare stock pickers to astrologers, but I don't want to badmouth astrologers. The second Nobel Prize, the second big input into modern portfolio theory came from a guy named Burton Malkiel You can still read his book. It's in print that came out in 1973. He's a Princeton professor, and he said that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. So modern portfolio theory basically results in most financial advisors and most investors managing money or investing with the idea that you diversify broadly into indexes, ETFs, mutual funds, you dollar cost average, you buy and hold, and you understand that you can't beat the market. Now, the problem with this is that the best investors in the world don't believe any of it is true. If you're to go back and look at this idea, the first one is that investors are rational, and it turns out that 2 Nobel Prizes have been awarded recently. One in 2002 to Danny Kahneman, who developed what is now known as behavioral finance as a field of learning, where he basically proved that the more expert that you are and the more pressure you're under, the less likely you are to behave rationally. When things are very difficult to figure out, as they are in the stock market, and where you have your life at stake, as big investors do at these funds, then you're likely to behave in ways that are not necessarily rational. In other words, it might be very possible that you would sell something worth $200 for $100 or buy something worth $50 for $100. You can do things that are irrational under pressure. And as a result of that, you have people like Warren Buffett and Charlie Munger, Manesh Pabrai, Guy Spear, who have beaten the market handily and can prove it. Warren Buffett went to Columbia University in 1984 and delivered a paper explaining that that there was no rational ability to say that investors don't beat the market when he showed the university class 20 investors who've crushed the market following the principles that I'm going to tell you guys today. Now, I'm going to kind of just create a little whiteboard of my own here. I'll just make a slide. Do my little new slide here, and we'll call this kind of thing, we'll call this rule number 1 theory. Okay. Now, rule number 1 comes from Warren Buffett, who said there's only 2 rules of investing. Rule number 1, don't lose money, and rule number 2, don't forget rule number 1. So my first book was called Rule Number 1, and it kind of got in deeply into explaining how you would invest and trade based on Rule 1 concepts. The first basic idea of Rule Number 1 is that in order to be a successful investor, you have to understand the business. This is something that most options traders forget. They forget that there's a business underlying this thing, which is why modern portfolio theory is so attractive to options traders. Because if modern portfolio theory is true and price equals value, then you don't have to understand the business. All you have to do is operate based around mathematical structures. But this is not how the best fortunes and the biggest fortunes in the world have been created. They've been created by people who understand the business. And it turns out, if we do understand the business, we will find ourselves investing in options with an edge. And you all should know already that anytime you're gambling or speculating, let's see, anytime you are speculating, essentially, I'm just reading some notes here that are coming in, that you're speculating, basically what you're looking at is an opportunity to have an edge. Now, right now, are you guys seeing that I've got slides up on the screen? Does anybody see this thing that says Rule 1 Theory? Is that on your screens at all? Just type in a little text if you see it or if you don't see it. Okay, you guys do see that. All right, PowerPoint's visible. All right, so right now you should see Rule Number 1 Theory, and you should see kind of how, as I do this real time. So number 1, you got to understand the business. Otherwise, the next one won't matter. Number 2 is that you must look at businesses with a moat of some sort. That is, you need to know that the business has some means of protecting itself in order that you can go about getting an edge. So if you have a business without a moat, that is, all it does is just compete based on lowering its prices, it doesn't have any franchise in the market, then you've got a problem playing around with options, because a company with a moat, and also with number 3, let's go get that in here. on a second. And number 3 on this thing would be that you have management with integrity. And I'll put up number 4, which is you know the value and you're getting a margin of safety. But I'm going to change this. This is typically what we think about as margin of safety. But really what we really want to know is what's the value of the business. Okay? Now, these are not normally what you look at for trading options, right? This is pretty different. This looks like long-term investing. But we do very well as an options trader by applying Rule 1 theory to options. And that's kind of what I wanted to show you guys today. So if we understand the business and we understand that it has some sort of protective, some sort of ability to protect itself in the market, like it's a Coca-Cola or a Harley-Davidson or pretty much any other big name companies have some sort of ability to protect themselves. We don't necessarily know whether the management has integrity when we're diving in at the level of trading, but we'd like to believe that they do. So we're picking fairly sizable companies here, which is, you know, not a problem for an options trader since we're limited to fairly sizable companies anyway. And then finally, and this is where we get our edge, if we've got the first 3, then we can predict the future of the business. We can make a reasonable prediction. And I'll go over today with you guys a little bit about how I go about figuring out the prediction on the business. And that prediction is essentially saying that I have a fairly decent idea what the future is going to be of this business, and therefore I have a fairly good idea about what the cash flow looks like. And if I have a fairly good idea about the cash flow, then I can figure out what this business is worth today. If I don't have any of those ideas, then I don't have any idea what the business is worth today. And if I don't have any idea about that, then you should understand that the market is going to tell you in options trading that at the money, you have a 50-50 probability of that stock price going down or that stock price going up. And that 50-50 probability doesn't give you any edge. So what we want to do is we want to understand, when can I invest in options when in fact in the real world the delta at the money is not 50, when in the real world it's definitely not 50. And when we have that, we have a really good chance to make money in an options trade. All right, so let me just ask you guys something real quick. You guys can answer me. Is this interesting to you? Do you want to dig deeper into this? Just let me make sure that we're all on the same page and you're starting to see that there's a value in the edge. Let me see if you guys are agreeing. Go ahead and put them in there. All right, cool. We've got some interest. Okay, good. Now the trick, of course, with options trading, the way we do it is we are options traders that predominantly focus on very, very low risk environments. The criticism of our way of doing options is that, yeah, these guys eat like chickens, peck, 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 but when it's bad, they get dumped on by elephants. So that means that we make a very small amount of money, very, very tiny bits of money, but make it most of the time. And when things go bad, they go bad indeed, right? They go very, very bad. So our job using Rule 1 theory is to invest in those kinds of times, to trade when we have an edge, and that edge gives us a very high probability of success, better than the probability out of the money says that we have. So for example, if we're going to do a bull put spread, what we're looking at for a bull put spread is that we understand the business. The business has a moat. It's got management with integrity, and we believe we understand the value of the business. So let's talk about one specifically here. So let's talk about one that we're doing recently called Chipotle Mexican Grill. Now I just want to emphasize, and I'm sure that everybody at TradeStation would like me to do this, that nothing that you hear should be construed as investing advice or trading advice or recommendations to do anything at all. This is all historical stuff. If you do this going forward, you're really on your own, and you really have to do your own work. So I hope everybody understands that really well. So let's dive into what this tells us. Do we understand the business? Yeah, we understand the business. They make just that. We make burritos, so we're in what's called the quick service restaurants. That's who we're competing with out there in the world. So, okay, we got the idea. Now, how hard is that? Well, you just go to burrito place and eat a burrito and see if you like it. It's not really difficult to do the kind of homework here. You can read their 10K and kind of see what they do. Now, do they have a moat? What do these guys rely on for protecting them against competition? And the answer is it's the difficulty of making fresh food every day safely, right? Safely and perfectly. So that's the moat. Now these guys have something like 2,300 restaurants. All of the other burrito people piled together don't have even 2,300 restaurants. It's very difficult. They're the only nationwide company that if quick serve you fresh food made daily, no dye, no nothing in it. It's all really gourmet food. And you're getting it in a quick service restaurant. So they found a way to do that. They had a glitch. That glitch has just ruined their stock price, right? And that has created an opportunity for us. Now the management with integrity, these guys are run by a guy named Steve Ells. He's bringing in a new CEO, but he's also the founder. And I really like the guy. He's a very ethical guy. In fact, the whole company is built around that kind of ethic of quality food for the regular person. Now then, what's the value of this business? How do we figure out what this company is worth? Okay, fair enough. Let's go to the next slide and see if we can pull in some data here. So what we want to do is we want to understand a few things to build a model of what the value of this business is. The first one we want to know is what are the earnings per share? And the trailing 12 months will do fine if it's typical. Then we want to know what is the growth rate, and then we want to know the PE ratio that this company will have in 10 years. All right. So this is the 10-year PE. Sorry, I'm having trouble seeing my screen. There it is. And then finally, we want to know what is the minimum acceptable rate of return. All right, to put a value on the business. So in Chipotle's case, they've suffered this huge meltdown. And what we want to do is we want to look out into the future for 10 years. So we want to grow this earnings per share for 10 years at this growth rate. Now, we got to figure out what's the correct earnings per share to use because Chipotle has suffered this meltdown. If we use the earnings per share now in the valley of their performance, we're going to end up with a pretty terrible number. But if we can look into the future, if we understand the business well enough, we can look into the future and we can say, well, these guys are going to get back to their peak year reasonably soon and might have a little less overall PE, but they'll PE growth rate, but they'll certainly be able to get back to the other PE just simply from growing restaurant numbers. And they're in fact doing that. So we can put their PE or their earnings per share, let's say at roughly $16 a share. Now this of course takes some understanding about the business. You could disagree with me completely here and we could have a nice large discussion. And you know, that's what trading and investing is all about, is a difference of opinion in the market. But I'm starting with 16 bucks on these guys. And then their growth rate, of course, historically they've had a 21% per year growth rate. So we're going to drop that down a bit. We're going to put the growth rate, we believe it be more as they get back on their feet, at about 18%. So again, looking into the valley of what Chipotle is going through, we see that their growth rate right now is running in many parts of their company's sales and cash flow and so on. It's running at 40 and 50% because they're coming back up to where they were. So we're going to lower that one down for the long period. And then we're going to go out about 10 years here, and we're going to say, what would the PE ratio be if this company is still growing at 18% a year 10 years from now? Well, first off, can they grow at 18% for that long? Well, they've got 2,300 restaurants, and we know that at 18%, they're doubling their money every 4 years. So they're doubling. We'd say, okay, well, you're going to have to grow your restaurants. So let's say they grow their restaurants double every 4 years. So that'd be 4,600 restaurants in 4 years, and then 9,200 restaurants in 8 years. So we'll say that they'll have 10,000 restaurants in 10 years. Okay, that may be aggressive, but let's just use that number for fun. And let's say, yeah, we can see that they've been doing this better than this for 20 years, that McDonald's has 50,000, 60,000 restaurants, Burger King has 25,000 restaurants, that these guys can continue to develop their structure to do that. Now, let's say that you would argue back, no, they can't because they're not a drive-through kind of restaurant. Well, this is where understanding the business comes in. Steve Ells is going to turn them into a drive-through type restaurant, a mobile response restaurant. They're building out the ability to do that in every restaurant they've got. So they're going to be able to double and double, not just from the number of restaurants they have, but also for expanding what they're capable of doing in the existing restaurants. So I would say 18% is quite doable. That means the PE ratio should be, in a good stock market, about 36 times earnings. Now that comes from just a lot of experience in the markets. Obviously, some companies will not have a PE ratio in a good market that's 2 times their growth rate, but as a general standard, that's a pretty functional number. If Google is going to be growing at 10% a year into the future, they're going to carry long-term about a 20 PE. If Apple's growing at about 8% in the future, they're going to carry about a 16 PE into the market. It's a pretty good windage rough guide to what the PE should be. Okay, now what we're going to do is then we're going to put in one more number, which is the minimum acceptable rate of return. And this is essentially what business school would call a discount rate. And it effectively says that the value of $1 today that I'm going to spend on this thing isn't worth the value of $1 in 10 years. So I need to get a rate of return on all my dollars that are going out there when I'm going to put money out at risk. And so when I'm looking at long-term investing and trying to figure out the value of a thing, I'm using what's called a MAR. That is a minimum acceptable rate of return. We call it a MAR. And the MAR is 15% standard. So this is, we just default to a 15% return. Now, let's walk through this process here a little bit. We started with $16, and we're going to double that $16 every 4 years at 18%. It doubles every 4 years. So in 4 years, we'll have $32. In 8 years, we'll have $64. And then in 2 more years after that, we'll have about a quarter of a double, right? Or about, let's say, a half of a double. So that'd be another $32. So roughly, Chipotle should be, at this rate, it should have about, let's put this down here, should have a value of about, in 10 years, of about, we'll just do round numbers here, $100 roughly, all right, $100. Excuse me, in terms, it should have earnings, I'm not saying that right, it's earnings per share in 10 years of about $100 a share. All right, very good. Now we're going to apply the EPS, which is 36. So that means we'll have $3,600 of stock price in 10 years, assuming they don't split. And then we will use the minimum acceptable rate of return of 15% per year to determine the present value or the current value of that company. Now, a really easy way to do this, since this is a kind of a loaded formula, you'd stick it into Excel and you'd figure out the present value. We can do a shortcut here. Since we're using a 10-year time period, we know that 15% doubles your money every 5 years, and therefore in 10 years you have 2 doubles. So if I have $1 today and I double it once in 5 years, I'll have $2. And then if I double it again in year 5 to 10, I'll have $4. So $1 today at 15% growth rate becomes $4 in 10 years. Now, if we were to do it the other way around and say, okay, I've got $4 here 10 years out, what's that worth today if I have a 15% minimum rate of return every year? And the answer is $1. So cool. We can just divide 3,600 by 4, and that'll give us today's value. So today's value, we would say, is $900. 3,600 divided by 4 is the present value. Okay, now let's just go out here and play with this a little bit. Let's say that this number right here is 15%, not 18%, which would make this a 30 PE, not a 36. This stays the same at 15%. in that case, we're going to double this twice, right? So we'll go from $16 to 32 to 64. Okay, so out there we're going to have $64, not 100. So this is 64 bucks. And then we'll multiply that by 30. So 64 times 30 is about $1,920. We'll call it $2,000 just for fun. Round numbers. So look at this. You change it slightly from 18 to 15. Change this slightly from 36 to 30, and we've lopped a huge chunk off of the stock price in 10 years. So these numbers really do matter when we're guessing out there. So we want to be as accurate as we can be. And now instead of a $900 value, we have a $500 value. All right, so this looks pretty real to me. I feel like, okay, I've baked in some much more conservative numbers here. They don't have to grow their restaurants triple. They can only do it double. And they're still going to be worth about $500. All right, now I'm going to add to this a little search of what gurus are doing. So let's dive into what that looks like. We're going to go over to my website here. Let me find it. Let's see if you guys can see this. All right. You guys see my website okay? Everybody see that? Okay, good. So I'm going to log in right here. And this is where we do some work, okay? So I'm going to go over into the search fields, and I'm going to come down here and say search for guru stocks. I'm clicking on this. Now what this is a field or a pile of data that we pull from the SEC filings of really good investors. And we basically bring it in every quarter and update it and track whether these investors are buying or selling individual companies that we might be interested in doing trading in. So I really like to have some confirmation from good investors about my estimate of value. And the best confirmation isn't what people write down in a newspaper, it's what they're doing with their money, right? Chipotle Mexican Grill. And we see that there are two investors in this stock right here. So let's click on that. Now, by the way, when I say there's two investors in this, I've curated that list of great investors we call gurus. I've curated my list to 46 investors that invest like I do, and who, if they do options, do them similar to what I do. And in this case, we've got two investors here. David Pope, who is really, really good investor, and he's put an itty-bitty tiny little bit of toe in the water into this Chipotle Mexican Grill. And then we have Bill Ackman, who is a phenomenal investor, is managing about $4 or $5 billion. We can see he's got 16% of his portfolio in this thing. And when you're talking about several $billion, that's a lot of money. He's very deep in this, and we can come in here and see kind of what did he pay. And we see that he paid $427 at one point, and they paid at another point he paid $414. So he ends up with a big chunk of this company. In fact, Bill owns just, I think, right at 10% of Chipotle Mexican Grill. Now, this tells me something, doesn't it, about my estimate of the value of this business. Bill Ackman is an investor like me. He wants to buy things when they're on sale. He doesn't believe that the market prices things exactly. He doesn't believe in modern portfolio theory. He believes that every once in a while the market will misprice something because they overestimate the problem. In this case, they've overestimated the problem of Chipotle recovering from this E. coli problem. All right, so he's in at 414 and 427. Good to know, right? Because I'm thinking the company's worth 500 or so, and I've got one of the best investors in the world, the guy that makes phenomenal rates of return, who's in it less than that. So that gives me a lot of confidence about the directionality of this company. And now I can start to see that I've got two things going for me here. The first thing is I've got Ackman, who is interested in owning more of this business, who's buying in at 400. And second, I've got the value of the business at something like, 500 bucks. Now let's go over to Chipotle Mexican Grill, and see what it's selling for today. So let's pull this up. And we can see that the last price out there today was $314. It's bouncing around between $300 and $320 right now. So I have a situation here that indicates to me that I may have an edge. Okay, I might have an edge. Now, I can also go over to the price chart, and I can see a little more about the potential edge here. And that is that over the course of the last, couple of months, last few months, we see that the stock price has floored up here at about, I don't know, 400 or so. You can kind of see the floor shaping up right there. So that went on for quite some time back in 2016, early 2017. And then it started to take off toward what I suspect is its value. And then it crumbled because they had another food scare. And the food scare, actually, it came from two things. They're slowing down the number of restaurants they're building out, and that made people nervous on the short term. And it also, they had this food scare with the norovirus, which people don't distinguish from foodborne diseases, and it's not the same thing that they had clear back in the old days. And we see now it's kind of floored up here at 300, dipped down briefly, and came back up. So what we're looking for as an individual, as a trader, is I'm looking for an edge, right? So the first edge I've got is that one of the best investors in the world is buying in at around this kind of price and not selling at this kind of price at all. Second, I've got a value up here someplace. Third, I've got a pretty good floor that this market is holding on to pretty well. It's holding on. It came down here briefly during an earnings call, and it shot back up very quickly. So if I'm pretty confident about my value being up here from these different sources of value, then I can place trades where other people are afraid to go. And that's where I get my edge. So right here at this current price, the delta, or the probability, is 50-50 that this stock price will go up or go down according to modern portfolio theory. Now what I can see is that it might go down, but it's not going to go down much more than right here unless this floor gets broken by something new, right? So there's risk in everything we do. There could be a new outbreak. Of course there could. But I'm of the opinion that they have it pretty well under control. They haven't had any serious E. coli problem. They haven't had any E. coli problem that I'm aware of for almost 2 years now, a year and a half. So I think they've got it under control. And I think that's probably the real downside here. So whereas a 50-50 bet says it could just go down as much as it could just go up, I'm thinking it could go down a little but not a lot. Now, in that kind of an environment where it can go down a little but not a lot, where I've got great investors coming into this stock, where I've got a good floor down there, and where I've got a very strong opinion of value, that creates an opportunity for an investment for me. Now, I'm just curious. I can see what you guys are going to say here. Tell me, what kind of an investment do you think I can make? What kind of a trade can I make in this environment right here? What looks good to you? All right, so let's see if you guys have an idea here. What you would do if you had those kind of, if you believed in that kind of an edge, where it is, let me say it succinctly, where it's much more likely that this stock price will go up than it will go down, that the probabilities are wrong down below, right? They're wrong. All right, very good. So we've got a couple of different possibilities here from some of the people watching this. The first one is to go long on this thing. Okay, so we can go long, which would mean, if we're going to look at just strictly a stock trade, we're going to buy this and we're going to hold it because we can buy it right in here at 300 something, and it's likely to go to 500 if things are good, and we end up over here at 500 maybe a year later, 6 months to a year later, and we've nearly doubled our money in 6 months to a year. That looks pretty good, right? So if you're a trader and you can make 50% in a year, you're doing really, really good, right? You're in the top percentiles of all the people who are trading out there, and you could do it just by taking a long position, which of course, as opposed to trading, doesn't give you the same downside. I mean, unless this thing goes to zero, it's not like a trade. A trade can go to zero, but this thing, or a trade, can get a lot worse, right? And you can have a lot of losses. But if you go long, you can just go long on it and own the stock. You could put in, as Nequan is saying, you could put in a tight stop and just say, okay, I'm going to stop out of here at 250. If I'm wrong, it's going to get taken out. Good call, man. And then Robert is saying, what happens if the general market crashes? What's the correlation of CMJ to say, SPX? Which is a very, very insightful thing to ask, my friend. So I'm going to move away from what I would do here and what we'll come back to, which is an option called a bull put spread, which several of you are putting out here and saying, hey, I'd like to do a bull put spread, and others are saying I'd like to sell a put, just a naked put, which we call a Rule 1 put, and we'll get back to that in a second. Let's talk about the SPX potentially crashing. And then what would be the correlation between the SPX crashing and Chipotle Mexican Grill? Very, very good question. So again, we come back to those 4 things we need to understand about a business. We got to understand the business itself, what the quality of its management, the moat it has, and the value of the business. And we can go back to take a look at your stock chart and run back to 2008 and kind of see what's the correlation, and you'll see that Chipotle is correlated to the market crash, right? So you're gonna get taken down with the market in this company if it were priced properly. Now, the other side of this is if it's already at a major discount to its real value, perhaps the market goes down 50% and this stock goes down 25%. But still, you don't want to get pounded by a market meltdown. So it's absolutely important that we understand where we are with the market. So I'm going to take you to a couple of things that I use to get an idea of what's going on with the market. And the first thing is called the Shiller PE. So I'm going to type this into Google, Shiller PE, and what will come up is the Shiller PE ratio. And it looks like this. The Shiller is developed by Dr. Robert Shiller from Yale, who wrote a book in 1999, which was the first major torpedo into the modern portfolio theory ship. And Shiller got the Nobel Prize for this in 2013. So this is a pretty insightful piece of work that he built that explains that the market has an average adjusted for inflation and averaged over time, a PE ratio, he calls the cyclically adjusted price earnings ratio, of about 15 to 16, right across the middle of this thing right here. Can you guys see my mouse okay moving across there? There we go. So right down the middle of this thing at about 16, that's what the market is averaged. And you can see that it doesn't stay there a lot. It moves through it a lot. And we can see the modern market for the last, what is that, 20, almost 30 years now, the modern market is very different than the market back here and back here. So for 140 years, it's been at about 16 average. And we can see that based on this chart, when it gets up here into the high 20 or the mid 20s, it tends to come crumbling down. And from this point to right here in about 1920, so about 20 years across here, the stock market went nowhere. It was at 100, it dropped down, it came back to 100, dropped down, came back to 100. So for 20 years, the market goes nowhere, and the PE of the market continues to go down as the earnings go up and the price goes nowhere. Then in 1920, this started to go up, and indeed the market started to take off, and from about 1925 to about 1930, the market went from 100 to 200 to 300. So you have this huge run up, and the Shiller PE ran up to 30, and then we had the crash that started the Great Depression. It runs back up again, up into the mid-20s here by 1938, and then the Federal Reserve tightened up on interest rates, and that crash sent us into World War II. Now, from that point, World War II, it didn't get back up into that mid-20s area until the mid-1960s. It climbed all the way back up here into the mid-20s, and then went sideways, just like back here in 2000, or sorry, in 1900 to 1920, from 1965 to roughly 84, another 20 years, the market went absolutely sideways. It went to 1,000 on the Dow, and it stayed there, up and down, up and down, up and down for almost 20 years. And during that time, the PE on the market fell as earnings increased. Then in 1983, 84, it starts up, and we get a little blip here in 1987 that looked a lot bigger back then. And then up it climbs and just accelerates. We get up to 1998 here, and we're now, for the first time in history since 1929, we're at a CAPE ratio of 30. And this is when Warren Buffett stopped buying stocks and started looking at buying back Berkshire. This is when one of the great traders, Julian Robertson, ended Tiger funds and got out of the market, saying, I don't know what's going on. This is when Alan Greenspan said, the head of the Federal Reserve said we're irrationally exuberant. This is when Robert Shiller wrote his book. And it just came out in 1999, and like he was reading a crystal ball, the market crashes. Now, it came all the way down here until 2001. Then we had 9/11. The Federal Reserve and all the power of the federal government stepped in to prevent further chaos, driving up the market for a brief period of time. And then we had the crash created by all of the subprime mortgage bonds starting to collapse as the real estate went into a bubble, and the market started to completely crumble underneath that. And this is where it would have gone. It would have gone down here with great certainty. We would have gone into a depression, and we didn't. And the reason we didn't is because the Federal Reserve spent $4 trillion of newly printed cash, poured it into institutions to prevent them from having problems, and reduced interest rates to zero. And that left only the stock market as a place to invest, and it has benefited from that result all the way till now. Now, today, Janet Yellen started tightening more on what interest rates are, and I don't think we had much of a reaction to it. Everybody expects it now. The economy is starting to really take off with Trump out there cutting taxes. It looks like the tax bill is going to go through. So what we're seeing is a lot of things that are going to increase the earnings in companies, and this may just continue to rise with all of this good news. But we are now in our third time in history when we've been above a 30 Shiller PE. And that means to many people, including me, that we are looking into the barrel of a gun in terms of the near term. And somewhere in the near 2 years, 3 years, something like that, we're going to have some significant problems. Just to mention that nobody saw any problems right here. Things were going great. Nobody saw any problems right here. Things were going great. Nobody saw any problems right here. It's a whole new world of internet investing, and the problems are disappearing more and more right now. So from the Shiller PE perspective, we are in no man's land and deep into it. So I keep that in mind while I'm trading. Now, the next thing I look at is I go over to the Federal Reserve by Googling the Fred Wilshire GDP. Fred Wilshire GDP. And you'll get the Fred, which is the St. Louis Federal Reserve regional office. And they create a lot of cool slides around the market. And this one in particular is the one that Warren Buffett said he looks at when he was interviewed in 2001. And he basically pointed out that here in 2000, the market had climbed up to a 117% ratio of the market price, which is the Wilshire 5000, against GDP, which is the gross domestic product. In other words, at this point in 2000, the Wilshire GDP was about almost 20% more expensive than gross domestic product. Back here, for years and years and years, all through this time, you can see that the relationship between the market and gross domestic product was really that the market was much, much cheaper than our gross domestic product. And then gradually, the market takes on more and more significance and climbs all the way up here. And Buffett's view from 50, 60 years of investing is when it gets up in here, the relationship between stock market prices and the actual value of those businesses has become unhinged, and you're going to see the stock market go down. And indeed, that happens here. The stock market goes down, back down to about 60%. And when it gets around 60%, Buffett was very clear in saying that that's a pretty good time to buy stocks. So you want to go long at 60% and adjust your trades so you're expecting the market to go up. And when it climbs back up to 100%, we get into trouble again. That's when 2009 came, and it crashes down to below 16%. We get everything on sale. And then we climb up here, and again, look at how much this goes up. We get up around 120% here in 2015, and the market starts to crumble, right? The Federal Reserve backs off very quickly from from reducing interest rates, or raising interest rates rather, and then we start to get the Trump impact here in 2016, and up it goes as we are now looking forward to much lower tax rates on corporations. They're being almost cut in half if this bill goes through, and we are now at a 155% market price versus GDP. So we're now way out ahead of any of the future GDP. And this is, in the view of a lot of great investors, including Buffett, this is unsustainable. You can't stay here. So either GDP has to explode at something like Chinese rates, like 8% or something, or we're going to stay massively overvalued, or we're going to crash. So these are the two things I look at in terms of what's the fundamentals underlying the market values. And if I've got a Schiller up here in the 30s like I do right now, the third time in 140 years, and I've got the Wilshire GDP up here in just astronomical territory, driven by the fact that there's no other place to go. You can't put your money in bonds. So you end up with this huge bubble. And that's what I think we're looking at. We're looking at a huge bubble. So if we're looking at a huge bubble, I need to know that, right? I need to know that in terms of what can happen here. Now, the good news is if we are in a huge bubble, with the exception of maybe 1987, we don't really see the market completely collapse overnight. We're going to have time to adjust our trades and get out. We're going to have time to do some things that we can do. So the trading that I do is basically based around these concepts. I am looking at a kind of a scary market that could come down. I'm looking at a stock which has gone through all kinds of hell and has got a pretty firmed up here at around 165 or so. And I can, as you said, I can go long on this, and I have. So full disclosure, I'm long this particular stock. And I can also do what's known as a naked put. I can sell a put down here someplace that will give me a pretty decent rate of return. So if you're looking at TradeStation, what you do is you'd go into the TradeStation trading screens, and you would look at one of the expiration dates. I would, if I'm going to do this, I'm going to do it at a leaps put. I'm going to put it on a January put, probably January of 2019. I'm going to go out a year, and I'm going to probably lay that put in here around 250, 260, something in that range, where I think it's very unlikely that stock will be there in a year, and I'm going to collect a big fat premium because it's being priced as if it's a 50-50 probability to go there or go there. And I don't think that that's a 50-50 shot. So I'm going to get an edge that I can use to determine where to place this trade. All right. Now, let's talk about one more possibility we can do. We can go long here. We can buy a call, right? Another form of going long, much more leveraged, where we'd say, I'm pretty comfortable with this thing going up in a very specific time frame, and I'm going to buy this call. I think that I don't do long calls very often. I find I don't like to be able to, I don't like to try to guess when this is going to happen. This could happen if I go long the stock right here and this doesn't happen for 5 years. I've still almost doubled my money in 5 years, and I'm making almost 15%. I don't have a 5-year option, right? I've got to pay a big chunk of money here. That's going to impact my basis overall if this thing doesn't go up fast enough. Now, I think it could, but you know, and I think this is not a bad shot for a call. Again, I'm not giving you advice, just giving you some education here on how one options trader might do this. But I like to go long. I'm comfortable with long the stock and then short the put. I like that combination of things because I like to get short the put here and collect premium, which reduces what I have in the stock, is how I look at it. So, for example, if I buy the stock, let's say right here, which I did, at around, let's say 280. If I buy the stock at 280 and then I sell this put, maybe a 2019 put, I might get $20 for that thing, particularly when the stock price was right here. And that could reduce, I might get 30 for that actually. And that can reduce my basis here. Instead of having the stock that I would own at 1,000 shares at 250 or 280 rather, I buy 1,000 shares at 280 and then I sell 100 contracts. Sorry, was that 10 contracts or 100 contracts? I sell 1,000 shares of puts right here and collect $30 per share on the put, and that means I've collected $30, I've spent out $280, and I'm net $250. So I now reduce my basis to $250. I like doing it like that, right? Because if this is indeed the floor, I've now got a 250 basis. I get all the way up here. I've doubled my money at 500 instead of a 60% return. Now, the third thing that I like to do, one of you mentioned, is a bull put spread. Bull put spreads are very cool for people that are starting with very little money. The problem with doing a naked put right here, even based on valuation, is that 1,000 shares of this is going to require that you have the ability to put up $280,000. And if you don't have that, well, if you do have that, you're not a small investor, just starting out, that's for sure. So we don't get the benefit of that. So that makes us 30 bucks, okay, but we can't do it. So we lower it down to one contract or 100 shares, right? And 100 shares is going to require that I have, what, 280 times 100 is $28,000. So I got to have 28,000. I'm still not a little investor. All right, so I can't even do an option on this thing. Well, yes, you can. So you guys already know how to do bull put spreads, almost everybody here. But let me just show you how I would structure this particular bull put spread. Now let's go back over to our screen here. And I'm going to build another slide. And we'll call this a bull put spread. So bull put spreads are pretty cool because they have a structure to them that depends in large part on your understanding of the edge. What's the real value of this business? Because a bull put spread is saying that you hope the stock price goes up. Right? So it's a bullish trade with a credit spread that's going to pay you cash. Now, if you remember, the advantage of a spread trade is that you don't have to have a lot of money, because whereas when you do a 280 rope, a 280 rule 1 put or a naked put at 280, you're exposed to the entire $28,000 obligation to purchase that stock sometime in the next whatever, right? It's a month or 2 months or 6 months or a year. You're exposed to that obligation for that length of time. And the broker is going to require you have the money to cover that obligation. So it's $28,000 for every single contract you do. If you don't have the money, what you can do is you can sell to open the 280, which is what you would do if you had a naked put. Sell to open the 280, and you will collect a certain amount of premium. Let's say you're going to collect $10. So you get $10 by selling to open the 280. And then what you're going to do is you're going to hedge it by buying to open the 270 on the same expiration, whatever you're using there. And in this case, it's going to cost you. So on this one, when you sold to open the 280, you incurred an obligation. When you incur an obligation, of course, you are going to get paid for that obligation. And you're going to hedge it by buying, using the money from this obligation that you sold and you're now obligated for. You're going to buy this 270 strike. The next strike down is the one I like to do. And that's going to cost you, you know, whatever, let's call it $8. So minus $8. So you end up with a spread, a credit spread. So you get a credit spread on the bull put spread of $2. Okay. Now, what's your rate of return here? Well, what's your risk capital? So risk capital is equal to the spread minus your net credit. So let's rename this the net credit right here. And we can say that that's an NC, right? Net credit. And risk capital, which we can say is an RC, risk capital, is equal to the spread minus the net credit. All right. And in this case, that would be $8. All right, so there's our risk capital. And let me make this a little bit smaller here. All right, so our net credit deducted from the spread gives us our risk capital, or RC. Then we want to know what's our return on risk capital. Our return on risk capital. Sorry. For some reason my mouse just won't let me quite see it. There we go. Return on risk capital. Let's try to spell it right here. So return on risk capital is equal to the net credit, which you got, divided by your risk capital. And so that in this case equals 2 divided by 8, which equals 25%. All right, so there's your return on risk capital. And now we want to understand how to compare this trade to other trades that I'd be looking at. What I'm going to do is, actually, let's get rid of these things for a second. What I'm going to do is I'm going to do another calculation here. But first, before I do that, I want to point back out that you've gone from not having $28,000 to only needing this $10 spread right here. And depending on your broker, like TradeStation, they will sometimes let you have just the $8 risk capital. That would be all you'd have to have per share. Since you're going to do 100 shares minimum, the maximum they'd require that you hold on to would be 100 times $10 or $1,000. So now all of a sudden you can take a really good trade, which is, look, I'll be happy to buy this for $28,000 for 100 shares and turn it, but I don't have $28,000, and turn that into a really nice trade where you'd only have to have $1,000. Now, the big thing you need to understand is that when we do what's called a Rule 1 put, and I am looking at $280 purchase price, I'm obligated to purchase for $280, I don't consider that I've got risk there other than the risk that I would have as an investor. I don't have a trading risk. And the reason is because I won't do this naked put unless I am very excited about buying this company right now, today, for $280 a share. Now, if I can buy it for $280, I'll buy it for $280. And typically, like I said, I start the trade off with a purchase at $280, and then maybe I'll do a $280 strike put. Or maybe what I'll do is I'll just drop it down to $250 and do the next essentially the next tranche into the investment at a $250 strike. But in either case, the most critical thing is I want to own the stock at that price. Okay? So what happens if the stock price goes to $200 overnight? Well, if I have a Rule 1 put, then I'm going to get put that stock, let's assume it stays there through the expiration, I'm going to get put that stock at $280 a share. All right. And it appears that I've lost money on this trade, but in my view, I haven't. In my view, what I want to do is buy some more of this thing at $200 because this is a $500 investment. In other words, at $200, I'm buying $5 bills for $2. And I want to do that all day long. So it's very different sense of risk when you're looking at purchasing the stock and you have a very strong opinion of value and you're willing to be in it for a long time. So when I look at it like that, as an investor, when I do a naked put or a Rule 1 put, I don't feel I have risk in the actual option. I'm happy to get put the stock. In fact, that's my first choice, is I'm trying to get put the stock at $280. Now, when I do a bull put spread, that all changes. Suddenly, I have serious risk in the option because I'm going to do this with a lot of contracts. We noted that I can't even, I can't buy one contract here. So if I do a bull put spread, I'm not going to be able to take off one leg of the spread and get put the stock at $280. I can't even do it with one contract. I mean, what if I do 10 contracts here, right? What if I'm working with $10,000 and I'm going to do, I still can't do one contract as a naked rope, a Rule 1 put, but I can sure do 10 contracts as a hedged bet, as a bull put spread. And when I do those 10 contracts, if I were to sell the long position and remain naked on the short position, I would suddenly be obligated to buy 1,000 shares of stock at $280 a share, and I can't do that. So my broker won't let me remove the hedge. So I'm at risk. I can't shift this over to a Rule 1 put because I'm in too deep. So I've got to be able to assess the risk here. And that's what I want to do next. I want to assess the risk. So I'm looking at return on risk capital, and then I want to look at one more thing, which is annualizing this situation. And to annualize it, I want to know what's my return on annualized. I'm not going to call it. See, I'm going to say it's annualized return on risk capital. So this we would say is return on risk capital right here. Parens RORC. Return on risk capital. So annualized return on risk capital is also known in our terminology as ARORC. Like that. So ARORC, real simple. You're essentially just taking the amount of time that this particular options trade is going to last, so the number of days you have to expiration, or DTE, and you are multiplying, or you're dividing that into 265. So, or sorry, 365. So let's say this is a 60-day, what's something easier, 30-day trade, right? So this is a 30-day trade expiring in a month. Then what I'm going to do is I am going to divide 365 by those 30 days. We'll call it 36 days. It's for nice round numbers. And that means I have a multiplier of 10. So I'm going to take my return on risk capital times the multiplier, and I'm going to get an ARORC. Equals the ARORC, which equals 250% annualized. All right, so this would be an insanely good one. I don't hardly ever see anything quite this good, unless we're doing maybe an iron condor or something like that. But you just get the idea. Typically, our 30-day returns, to put this more into the real world, would be, let's say, $1 on this. So you have $9 of risk capital, and you have a dollar gain. So it's 1 divided by 9. And that's not 25%, is it? It's about 11%. So 11%. And then we would look at that as a potential of about 110% return. 110% return. And we're going to get that by structuring it as a certain kind of trade. Now I'm going to actually back off of even these numbers here in a minute. So here's how we go about it. Setting up a bull put spread, what we're going to do is have a formula here. And the formula looks like this. Floor 90, 10, 11, 48, 20. All right, so this is our basic formula for structuring the trade. Now, some of this I'm going to leave for when you guys come to class, because it's going to take a lot of time to explain it all. We run a class up here in Atlanta once a month for free for TradeStation students. It shows your TradeStation students, we'll give you a scholarship. The class has been sold all over the world at $4,000 for those 3 days. But absolutely, you can come for free. Just go on our website and click in, and or maybe there's a link for TradeStation. We can set that up for you if there is. But the website is, let me just give you that real quick. So rule1investing.com. And if you have any trouble trying to figure this out, you can email into registration at rule1investing.com. And our team will be happy to work with you. Just tell them you're a TradeStation investor and trader and you'd like to come to class. All right, so here's the floor, 90, 10, 11, 48, 20. Now, I'll tell you what some of these are so that we can get an idea here of how this works. Floor is based on Fibonacci analysis, and we do pretty extensive Fibonacci analysis in class, and we're going to dive into that. I'm not going to do it here. And you really want to be basically 2 floors down from how I teach you to use a Fibonacci. So assuming you found a couple of really good support floors and you're down below the second one by a certain percentage, then the next piece of this is 90. And what 90 is a 90% is basically it's equal to or greater than a 90% probability OTM. So this is probability of being out of the money by expiration of 90% or greater. So we're looking at an opportunity here where we're going to place the strike at a point where we have a 9 out of 10 probability of being successful at expiration. So that's 90% probability OTM. And the next one is 10, which we're going to say equals or less than a 10% delta. Now the delta, of course, is literally the amount of money the option is going to change. The premium will change for every dollar move in the price of the stock. But it is also a kind of hidden probability analysis that works out a little different math than probability OTM is set up. And the delta below 10 or below is essentially the inverse of the probability 90 or above. So this is basically saying that the delta of 10% says that you've only got a 10% chance of losing on this thing at expiration. Okay, so we want to get both of those together. Then the next thing is, that's the 90-10. The 11 is equal to an adjusted percentage, adjusted percent out of the money. Okay, and we want that to be 11% or greater. So this would be equal or greater than 11% from the money. So wherever the stock price is, we want to place a strike 11% below that or greater, farther from that, from the money. Now this is the beauty of options trading the way we do it. If there's a lot of fear in the market, you're going to have the probability OTMs be at 90% and at 10 delta, and those things might be 20% from the money. They could be vastly far away from the money because of the fear that's in the air that the stock price will drop, and then you get the market pushing these way far away, and we can get into a very nice return on investment and still be a long way from the money. So this is where we start at 11% probability OTM. Needs to be down there. And then the 48 is equal to an ARORC, ARORC, of 48%. 48%. There we go. Now we already learned how to do an ARORC. So a 48% ARORC for a 1 month trade is going to be about 4%, right? So that previous example was still a little bit aggressive. We had it at 110%. Well, wait a second, that's better than 48%. So surely that would be a great place to put that trade. We could put the trade right there. We're getting 110%. That's going to give us everything we're looking for, assuming these things are all correct. And the answer to that is actually no, that is not the case. What we're going to do is understand that in trading options, pigs get fat, hogs get butchered. Okay? When you're looking at 110% return in, what do we say, 1 month, then you are getting into the hoggy territory. You're placing your trade closer to the money than in our view you should. So we are going to use the 48 as a final arbiter of where that strike has to go. And I will be happy to take lower than a 48, but I get unhappy taking more than a 48. I'm going to use the 48% ARORC as a way of determining that I'm not too close to the money from my experience as a trader. And that means if I'm sitting here at 110% on the strike that I'm running this analysis on, I've got to move farther from the money substantially, looking to get less money in. So instead of taking $1, then I'm going to go look at maybe 50 cents, and that's going to mean I've got a $9.50 risk capital, and then I'm looking at 0.5 divided by 9.5, and then we're getting much closer, right? 9.5, and that's going to equal about 5% or so. And then when we do that multiple, we end up with a trade at 55%. So we want to be looking for something that is in the right proportion to each one of these sort of critically derived designators, or what we call a box that we're going to put our trade inside of. So 48. Then the final one, again, something I'm not going to spend any time on today, is known as the Kelly. And we're looking for a 20 Kelly. So the Kelly is fabulous and wonderful, and we'll tell you all about it when you come up for a class, and it's really fundamental to great investing success, is a 20 Kelly. So with that, you guys, I think I'm pretty well done. I hope you guys have learned something. We're basically looking to combine long-term investing strategy using Warren Buffett style investing, looking for the difference between price and value to give us an edge in the market. And then as a small investor, we don't have a lot of money to invest. We're going to do something like a bull put spread that takes advantage of the market trying to price everything at a 50-50 delta. And we're going to place a trade that gives us a very high probability of success. So with that, Don, I'm ready to turn it all back over to you, my friend.